Do you think the national debt actually matters? I mean, yes, the debt is at $33.89 trillion, and the amount of debt simply grows and grows and grows with no end in sight. And just the interest that the government is paying on the national debt looks like the chart of a penny stock. But they're just going to continue to kick the can down the road, right? They're just going to inflate the debt away. It doesn't really matter. I'm going to explain to you, number one, why the national debt actually matters. Number two, how they're going to attempt to inflate the debt away, and the Federal Reserve will end up being the sole owner of all US Treasury debt. And number three, how that will not work, but instead will cause the disaster they were trying to avoid in the first place. So it's clear that the national debt continues to grow year by year, and it is currently sitting at $33.89 trillion. And one thing that people are saying more and more today is that the national debt doesn't matter because it's just money we owe to ourselves. The national debt is a national asset. It is how we pay for our entitlements, and our entitlements are things that we all deserve to get for ourselves because we all live in the most prosperous country on earth. We deserve it, and the national debt is the asset that pays for what we deserve. Unfortunately, the national debt is not just money we owe to ourselves because there is no we and there is no ourselves. If you simply owed money from one of your pockets to your other pocket, there would be no asset and there would be no liability, there would be no benefit and there would be no entitlement. There would be no change, therefore you would not be advantaged or disadvantaged at all. But it's very clear that the national debt does advantage some people and does disadvantage others, therefore something other than us owing debt to ourselves is happening here. With the national debt, the way it works is that money goes from one person or entity to the government. That's step one. Many times this is going to be cash going from a bank to the government, or a financial institution to the government, or a corporation with extra cash lying around, or even your Aunt Sally who has some extra cash in the basement that she doesn't know what to do with, so she loans it to Uncle Sam by buying a US Treasury. But step one is that there is a transfer of cash from one person or entity to the government. So that's red flag number one, is that when a loan is created, when a bond is created, when a treasury, when the national debt grows, it is not because we have all collectively decided to all loan an equal amount to the government. It is coming from one person to the government. The second thing that then happens is the government takes that money and spends it, which means that money gets deposited into somebody else's bank account, whether that's an individual or a corporation. This could happen through social security checks. This could happen through healthcare spending and end up in the bank account of a large pharmaceutical company, or maybe a military industrial complex corporation where it winds up in the hands of somebody producing weapons that are getting sent off to a far off country. No matter what the situation is, that money is then getting spent and lands in somebody's bank account. Now, again, you'll notice this is not a dollar that winds up in everybody's bank account. First step, it goes from one person to the government, and then it goes from the government to another person. Now, the third thing that happens with debt, because it's debt, is that it has to get repaid. Now, for everybody out there that says the national debt is never repaid, they just pay it off by borrowing new debt, that's true, but that other debt is still getting paid back, even if it's getting paid back with new debt. And so in order to pay back the person that they borrowed the money from in the first place, they will either borrow money from somebody else, or they will tax money, which is taking money from somebody else. So in our example, the bank loaned $1 to the government, and then the government spent that dollar on a weapons manufacturer. Now, in order to pay back the dollar it owes to the bank, it's going to take $1 from your paycheck to pay back that dollar to the bank, with interest. And now that we've come full circle, we can recognize that the national debt matters because it is a wealth transfer. It is a temporary wealth transfer from the bank to the weapons manufacturer, or whoever the government spends the money on, social security, pharmaceutical, politician's paycheck. And then it is a permanent wealth transfer when they take it from your paycheck to pay back the person who originally made the loan. If the national debt was just debt that we owe to ourselves, if it was a national asset, then it would be equally shared in both cost and benefit. by everybody. And if it was equally shared in both cost and benefit by everybody, then it would be meaningless and ineffective and nothing would actually be happening. It would all be netted out to zero. But the fact that it does something means by necessity that somebody is winning and somebody is losing. And every dollar the national debt climbs is another individual who is losing at the expense of the winner chosen by the government themselves. For the next moment, I'd like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why Monetary Metals is doing something so revolutionary goes all the way back to when FDR outlawed gold ownership with Executive Order 6102. What a lot of people don't know about this gold confiscation was that it also outlawed the gold clause that was very common in debt contracts, which allowed people to get their debt paid back to them in gold if they chose. Fast forward from there to 1971, when the US left the gold standard for good, there's no longer any reason to keep this law in place. But what even fewer people are aware of is that this law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legal in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they're doing and nobody else is. They have created a way for you to get on your own personal gold standard by paying you a yield that is denominated in gold, it's priced in gold, and it is paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you start off with 100 ounces of gold at 4%, then you end the year with 104 ounces of gold. The yield is denominated and paid in gold, regardless of what the price of gold does. Your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do. I've gotten to know the team, and as a result, I've not only become a customer of the company myself, I use the products, but I've also invested into the company personally. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and open up an account today. But this is unsustainable, right? It cannot continue forever. Well, that's true, and that is why the Federal Reserve will eventually own all the national debt, and I'm going to show you why. This is a chart of the Federal Reserve's balance sheet, and you can see prior to the financial crisis, it was under $1 trillion, and after the financial crisis, it ballooned to over $2 trillion, and then quickly to over $4 trillion. Following the events of 2020, the balance sheet expanded to a peak of almost $9 trillion. Most of the assets on the Federal Reserve's balance sheet are US Treasuries, which means the federal government owes dollars to the Federal Reserve. The government owes money to the central bank. Now, the national debt is almost $34 trillion. So there are plenty other players in the world that the United States government currently owes dollars to. It owes dollars to China. It owes dollars to Japan. It owes dollars to pension funds and insurance companies and banks. But it also owes a lot of dollars to the Federal Reserve. Now, the government likes this arrangement because in normal circumstances, they don't actually have to pay any interest on that debt. The Federal Reserve is part private, part public, both in its ownership and in its control. So its leadership structure and its profit structure is part public, part private. One of the ways this works out is that after the Federal Reserve pays for all of its expenses, if it has any profits left over, it sends those profits back to the US government, which means in normal times, most of the interest that the government is paying to the Fed on the debt that it owes to the Fed, it's going to get that right back. Now, obviously, that circumstance is not true if it owes debt to anybody else. So when the interest on the national debt starts to skyrocket and become unbearable for the government, that becomes a problem because it is bleeding and has to continue to borrow more and more and more just to fund the expense of holding the debt. But if the Federal Reserve were to own all the national debt on its own balance sheet, then the interest on the national debt would essentially be zero because it would pay it to the Fed and then it would get it right back. Now you might think, well, that sounds nice in theory, but what could cause that to actually happen? Well, right now, when the federal government borrows, they borrow primarily from US banks. And this can continue for a long time until the banks run out of money to lend to the United States government. And it's not like that hasn't happened before. Back in September of 2019, if you remember, there was a little thing called the repo crisis. All of the cash and liquidity had been sucked out of the system because banks had continued to lend all that cash to the US government, which was borrowing extremely heavily. Up until that point, the Federal Reserve had not been buying treasuries, but had actively been letting their balance sheet decline. But when banks run out of cash, they start to fall over quick. And so the Federal Reserve did a 180 really quick and began expanding their balance sheet yet again. And they said it was not QE, which led everybody to call it not QE. QE is an acronym for quantitative easing, which is a euphemism for debt monetization, and it's simply the practice by which the Federal Reserve prints dollars to buy treasuries from banks so that banks can take those dollars and lend them back to the government. And so just like happened in September of 2019 when the Federal Reserve reversed course and started up not QE, at some point the banks get tapped out. They've lent all they can to the US government. There's not enough cash left in the system because this number never goes down. The government just continues to borrow more and more and more. And so eventually they end up borrowing all the leftover cash that's in the system. So the Fed steps in and buys that US government debt once again. The more they do this, the less incentive there is for other major players to hold US debt, which is why we've seen a decline in other nations like China and Japan holding US treasuries, and they've decided to start stockpiling gold instead over the last couple of decades. I mean, think about it this way. If Apple was offering to buy used iPhones at $2,000 a pop, there'd be no incentive for you to hold on to your used iPhone anymore. The incentive would instead to be to sell your used iPhone to Apple. Without Apple buying up those used iPhones, the price would be a lot lower, and so you know you can sell them at a price that is above fair market value. That's the same thing when the Federal Reserve is buying treasuries. They're buying them at a price that is much higher than what they would be going for if they were left up to the market. So the incentive turns to sell your treasuries because you know there's a buyer on the other side paying more than what it's worth. Over a long enough time horizon, this means that buyer who has an unlimited amount of purchasing power because they have the legal monopoly on printing the money, they will own all the debt. And as a side note, they're gonna own all the debt. This isn't just US government debt because eventually this results in a central bank digital currency in which all money is just ones and zeros on one ledger held at the central bank, which means that when you borrow or lend or anybody else borrows or lends, it's simply ones and zeros switching places at the central bank's ledger. Money just moving around on a spreadsheet. Now you might be thinking, well, it seems like then the national debt doesn't matter because as we've just covered, the Federal Reserve is eventually going to print to buy all the debt anyway, which is just another way of saying that they're going to inflate away the debt. So it doesn't matter. The problem is inflating away the debt just never works because essentially what you're doing is taking something that was debt, meaning the government promises to repay what it borrowed from you. Part of that promise is that the purchasing power you receive is equal to what you gave up. They're replacing that financial system with one where every time the government needs to spend a dollar, it's essentially just a new dollar being printed into existence. Whether that happens directly or whether that happens through a lot of legal loopholes through the Federal Reserve buying treasuries from banks who lend that cash to the government, it doesn't matter. The end result is that you finance government expenses through the printer. This means the real cost of the national debt ballooning continuously, even if it's financed by the printer, is that it is paid for through inflation, through price inflation, because the money becomes worth less. If you double the money, but don't double the goods and services, then all else being equal, the prices of those goods and services are gonna go up because it's gonna take more money than it did before to get the same amount of stuff. As a result of the increased hardships that are imposed on households through a higher cost of living, there's not as much tax revenue as originally planned in order to pay for the larger amount of debt. And as one final story to round out what's going on here, I would urge you to study the life of John Law. He was the scammer that brought a central bank to France 300 years ago in what we now call the Mississippi Bubble. John Law owned a company called the Mississippi Company, and so he went to France and he said, hey, look, we need a central bank so that we can spur on more economic progress here. So what he did was he got the bank charter, he got the legal monopoly to hold a bank in France. And he said, everybody, give me your gold and silver. We're no longer going to use gold and silver coins. I'm going to give you pieces of paper that are just as valuable as those gold and silver coins because they are backed by those gold and silver coins. In addition to that, just so you trust me a lot more, we're also going to back that paper money with shares of the Mississippi Company, so it's backed by real land, real resources in America. Once he collected all of the metal and issued the money, he would print a little bit more money so that he could spend it on projects that he believed would boost economic progress in France. Now, as he did this, some of the things worked out well, some of the things didn't work out well, but one thing that continued to happen was that the value of those paper notes would fall a little bit because you're printing more money, but you're not printing more goods and services. So the value of that paper would fall. So John Law got a great idea. He thought to himself, hey, look, this paper money is backed up by gold and silver, which I've already got as much gold and silver as I can get, but it's also backed by shares of the Mississippi Company. So what if I print some paper money and I use that paper money to buy shares of the Mississippi Company? That'll boost the value of those shares. And if the value of those shares goes up, then the value of the dollars that I'm printing goes up. Can you guess how this worked out? Because he couldn't guess how it was going to work out. What ended up happening was that people realized that those shares were worth more than they should be because he was printing money to buy those shares. What was the incentive then? To sell the shares. And as you can guess, if other people are selling, that pushes the value of those shares down, which meant John Law had to print even more money to buy up all those shares that people were selling. And as that spiraled out of control, eventually John Law ended up owning all of the shares of the Mississippi Company with worthless pieces of paper. Now, if that process doesn't sound familiar to you, just replace shares of the Mississippi Company with US Treasuries and his paper notes with US dollars. So the national debt does matter because it is a wealth transfer. And not only that, it is a snake eating itself by its own tail that will force policymakers into a course of action that will destroy the strength of those policies themselves. And of course, it's not all doom and gloom. You can do some very basic things with your portfolio to protect yourself and profit off of inflationary times and deflationary times. It requires having a few very uncorrelated assets in your core portfolio, understanding how to hedge your portfolio so you're never vulnerable to large drawdowns. And number 3, knowing how to take many small asymmetric bets so that when you're speculating on a future outcome in the markets, you don't have to resort to a large percentage of your portfolio with bad position sizing so that if you're wrong, you lose a very little bit, but if you're right, you have a significant gain in your portfolio. If you don't know how to do that, I'd love to help you out. Join Heresy Financial University. Make sure you do it before the end of the year. I'm currently running a sale. It will never be this low priced again. Use code LASTCHANCE2023 at checkout. Link is below. As always, thanks so much for watching. Have a great day.